Yeah, so as I said, there's a distinction when it comes to financial markets. There's a distinction between capital market and money market. Capital market in the sense that it deals in trading of long-term securities, that's in securities that matures after a year. So things like bond, things like shares, all these securities usually matures after a year. All right, you can, if you are the one who bought the bond, you can get your money back after a year. Normally bonds are after a year. And then we also have money market, a market that deals in purchase and sale of short-term securities. Example is treasury bills. So any market that deals with purchase and sale of short-term securities like treasury bills, it is called money market. Then again, we can make a distinction between primary market and secondary market. So I was saying that in Ghana, we call something GAX, Ghana Alternative Exchange. It's an example of primary market in the sense that if you want to list on the Ghana Stock Exchange, you first of all list on something we call GAX, Ghana Alternative Exchange. Because sometimes, if you look at the requirement of the main stock exchange, sometimes it's difficult for firms to just get up one day and then list on the stock exchange, all right? So usually, the Ghana Alternative Exchange is more like a preparatory exchange for firms to mature before they go into the actual stock exchange. So in this sense, when we talk about primary market is a market where new securities are bought and sold for the first time. All right. So primary markets are actually markets for new issues. Like when we issue securities for the first time, that is where they are bought and sold. Then secondary market is rather a market for purchase and sale of existing securities other than new securities. Okay, so the purchase and sale of existing securities other than new securities, we call it secondary market. That is what we do in the secondary market, purchase and sale of already existing securities. Now, when it comes to capital markets, as in the market for trading long-term securities, there are several participants, okay? We can have the firms itself, so when it comes to capital markets, there are several participants. Number one is the firm itself, the firms that are actually looking for money. So the firms that are actually raising money, okay, they are the people that will issue the security. So whenever you hear that firm A has issued securities, it means that they are the ones looking for money. So if you hear something like MTN has issued shares, it means MTN is selling shares and they want money. They will sell shares and get money, all right? So always, the firm that is raising the finance, we call it the issuer of the security. And another participant in the capital market is investment banks. So usually, investment bankers actually serve as more like an intermediary in capital markets. So they help companies in security issuing processing for a fee, all right? So they are investment banks, they do that. And then another key participant in capital market are the investors. So the investors themselves are also key participants in the capital market. Now, one key service provided by investment bankers is that they do something we call underwriting. So this is what investment bankers do. Let's say you are a new firm, you want to list on a stock exchange, but you want your share price to be sold for 10 cedis, all right? So what the investment banks, what they do is that they can promote your shares. But that's one of their work. They can promote, like they can do advertisement on your shares. I mean, they can manage the shares for you so that you can get a good buy. What they do is that when you bring the shares to them and you tell them that you want 10 cedis, per share, they will tell you, okay, your share, even though it will be measured in your books as 10 cedis, we will give you 8 cedis per share. So they actually underwrite the price of the shares. So the underwriting the price of the shares, that is what they will gain from it. So they will help you sell the shares to investors at 10 cedis, but they will give you 8 cedis. It means that technically they've underwritten it. And the 2 cedis difference per share will serve as their benefit or their profit for doing that business for you. So anytime you hear underwriting, it means that they will sell it at the price you want, but they will give you money less than the price, and the difference will be their commission. All right, the difference. So in underwriting services, they can do 2 things. Number one, investment bankers can do commitment, as in provide funds to the issuer, hoping to sell to the public. So they can buy it, like the investment bank can buy it at 8 cedis. Okay, and then they will now do the selling for you at 10 cedis. So it's like with that, the investment bank have committed themselves. The other one is best effort, where the investment bank undertakes to sell with best effort and does not guarantee funds to the issuer. They don't guarantee funds to you, all right? So they do it in 2 ways. Commitment, that you buy the thing, and then as to how they will sell it is not your problem. But for best effort, they will not buy, they will just come and take the shares and try their best to sell for you. Okay, so that is how they do underwriting. Now, there are several forms of security issue. So in issuing security, there can be several forms, all right? Especially when it comes to shares. When it comes to shares, we call something IPOs, initial public offering. So when it comes to shares, whenever we are issuing shares for the very first time, we call it IPO. Like some years ago, MTN Ghana issued shares for the first time. And those shares, we call it initial public offering, IPO. When you are issuing shares for the very first time, we call it IPO. And sometimes at the end of the financial year, instead of paying shareholders dividend, the company can say that, oh, we don't really have money, so let's issue more shares to you. So anytime we issue additional shares to existing shareholders, we call it a right issue. Right issue. All right? We call it right issue. So anytime we issue additional shares to existing shareholders, that form of issue, we call it a right issue. All right, it's called right issue. Anytime we issue additional shares to already existing shareholders, we call it right issue. Then there's also something we call private placement, which is sale of unregistered securities to one purchaser or a group. All right, anytime we sell unregistered means that those securities are not registered with any formal market. Okay, so whenever we sell unregistered securities to one purchaser or a group, we call it a private placement. And some of the examples are venture capital funds, mutual funds, and endowment funds. You can read further on these things. Now, as already mentioned, purchase and sale of securities that are already existing normally occurs in the secondary market. All right, the secondary market. So anytime we are buying and selling already existing shares, it means that we are trading in the secondary market. Now, transactions in the secondary market do not provide additional funds to the firm, share or bond issuer. The secondary market rather increases the liquidity of securities outstanding and lowers the required rate of return for investors. So usually in secondary markets, we said It is the market for purchase and sale of what? Already existing securities. This simply means that for secondary markets, whenever there is a trading going on, it doesn't increase money that comes to the firm. It doesn't. Because I'm a shareholder, okay? I realize I don't need the shares again. Then I'll go and sell my shares to another person. Technically, it doesn't provide additional funds to the original firm because the transaction has happened between me as a shareholder and another shareholder. And that is what happens in the secondary market. Secondary market, as I said, is the purchase and sale of already existing shares. So normally secondary market, those things occur between investors. It doesn't occur between firm and investor. It occurs between two investors because it's the purchase and sale of already existing shares. However, secondary market enhances the liquidity of the shares. Liquidity in business, when we say liquidity, liquidity is the ability to convert any asset into cash without a substantial loss in value. All right. Liquidity is the ability to convert any security into cash without a substantial loss in value. The ability to convert any security into cash without a substantial loss in value. We call it liquidity. So actually, if you think about it carefully, secondary market actually enhances the liquidity. It enhances liquidity of shares. It enhances the extent to which the shares of a firm can easily be converted into cash. All right. And then usually secondary markets are composed of organized exchanges like Ghana Stock Exchange plus over-the-counter market. So secondary market can be organized market or formal market. And an example is what? Stock exchange. In fact, in finance, when we say something is a formal or organized market, it means that it's a market where there are standardized transactions, there are rules for trading, there are issues of registration and stuff like that. But when we talk about over-the-counter markets, they are markets that normally occurs between two parties. So Ghana Stock Exchange is a typical example of formal or organized market. Reason being that in Ghana Stock Exchange, okay, there are formal rules of trading. You know, there's even, there are rules, there are written down rules for Ghana Stock Exchange. The transactions that occur there are formalized, okay? Yes. But over-the-counter market normally occurs between two people. There is nothing like an organized exchange. Whenever you trade, like whatever, like the things that people trade in, like people trading in Bitcoin and etc. Once it doesn't occur on a stock exchange, but you are just trading, it's just trading between two people, it is called over-the-counter, all right? So secondary markets can occur over-the-counter or it can occur on an organized exchange. And please, at this level, when you say market, never think of market as a physical building or a physical place. Okay, you should have learned in economics that market is simply interaction of what demand and supply. Demand and supply, that's a market. Okay, all right, so that is it about secondary markets. Now, when it comes to capital markets, I've already explained to us that there are three main securities that are traded on capital market. Number one is the bond. Number two is shares. And shares, it can be further grouped into preference shares and ordinary shares. Okay. And I said that in some countries, for preference shares, they call it preferred stock. Preferred stock. And then ordinary shares, some countries, they call it common stock. As I said, one of them is British, one of them is American. Okay, so when you hear the word preferred stock, it also means preference shares. When you hear the word common stock, it means ordinary shares, right? So these are the three main securities that are traded on capital markets for purchase and sale of long-term securities. So these are the three main securities traded on capital markets. And in the next few minutes, you are going to learn how to value these securities. Okay. Now let's move on. Now, to understand security valuation in a very simple sense, okay, to understand security valuation in a very, 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 very simple sense, just note that the price you pay for something or the value of something should be the same as all the money you expect from it discounted to present. So for instance, if I buy a share, okay, if I buy a share and I believe that at the end of year one, I'll get 10 cedis. At the end of year two, I'll get 10 cedis. At the end of year three, I'll get 10 cedis. I'll get at the end of year four, I'll get 10 cedis. It means that if I want to know how to value the shares, I will simply have to discount all these monies to present. I'll simply have to discount all these monies to present. So if I want to find the value, as I said, of the shares, it means that I have to discount all the money I'll get from the shares. I have to discount all of them to what? Present. Once I discount all that money to present, I should be able to find the value. And this is just common finance sense. I'm going to buy something and that thing will pay me 10 cedis every year for the next 4 years. How much should I pay for the thing? So all that you do is that you value, so the value of a security or the price of a security is the present value of what? The future cash flows you expect from the security. And this makes common business sense because you're going to buy something. It must be, the price must be worth how much you are buying it, right? So if I receive 10 cedis every year from it for the next 4 years, if I bring all those 10 cedis to present terms, that is how much I must pay for the thing. So that is the principle behind valuation of what? A security. You discount all the expected future cash flows from that security to present. So let's come to valuation of bonds. Now, what is a bond? A bond is a long-term debt instrument that is publicly issued with a face value repaid on maturity. It is simply a large debt obligation that is divided into units and issued to the investors, all right? So that is a bond. It's a debt instrument, it's like a loan. But there's a slight difference between a loan and a bond. So a bond is a long-term debt instrument that is issued with the face value repaid on maturity. And it is simply a large debt obligation divided into units and issued to investors. So that is what a bond is. Now, we must understand certain terms when it comes to bonds. We must understand certain terms when it comes to bonds. We must understand certain terms when it comes to bonds. What is a par value? Par value of a bond is the unit price of a bond at issue. So par value of a bond is the price of a bond at what? Issue. So at the time they were selling the bond, the very time they are selling the bond, the unit price of a bond is what? the par value, all right? So it means that, for instance, if you issue 500 bonds, okay, at 100 cedis, it means that the par value of the bond is the 100 cedis. Okay. The same way shares have unit price, bonds also have unit price. Bond, they also have unit price. The same way shares. So if a share price is 10 cedis, a bond, like one bond, its price can also be 10 cedis or 100 cedis. So the total amount you pay for a bond eventually will be the number of bonds you are buying times the par value. So if somebody is buying, as I said, 500 bonds at 100 cedis par value, it will be 50,000 cedis. That's what you pay when they are issuing it. All right. So the par value is the unit price of a bond at issue. We also have something we call bond rating. Bond rating indicates the credit worthiness of a bond issuer. And there are several rating agencies. I mean, we've all been hearing on the news that Ghana, they keep downgrading our bond rating. Like they keep downgrading our bond rating. All right, even though with time it will go up, and it's simply because of the economic conditions. Now, here, there are several bond rating agencies we must know. So there are some companies who have made themselves, or I mean, whose job is to rate the credit worthiness of borrowers. All right. For example of bond rating agencies, we have Moody's. We have Moody's, all right? We have Moody's. That's one example of rating. That's one example of a rating agency. It's called Moody's. All right, so that's an example. And from time to time, they bring out bond rating. So they normally use letters. So they can say your bond rating, this person, his bond, if Ghana is issuing bond, our bond rating can be AA or A plus or BB or like, that is how they rate bonds, at least to tell about the credit worthiness of the bond. And you can just read on them. One of them is also called Standards and Poor, S&P, the bond rating agencies. Standards and Poor. Another one is called Fitch. Like there are several bond rating agencies. Fitch. I think the spelling is F-I-T-C-H. Yeah. Fitch. Okay. So usually when they are rating the bonds, okay, they look at your credit history. They look at your credit history. So here, so they look at your credit history. So here, Ghana, for instance, they can look at our credit history and know that we have been borrowing a lot. Okay. And they look at your ability to pay. So if you borrow, like a country, if you borrow as a country, when you borrow, how can you pay? You pay from your GDP. So if your borrowing forms a huge percentage of your GDP, let's say your debt to GDP ratio is somewhere around 80%. It means as a country, you are very risky. So they will downgrade the bond that you issue. They will tell you that your bonds are not credit. You yourself, you are not credit worthy. So the bonds you are issuing to, they are not credit worthy. So usually, an issuer is not credit worthy when they look at your credit history. It is very likely that you may be unable to pay for the bond when it matures. Exactly. Okay. Someone is asking the difference between shares and bonds. Now, shares actually gives ownership in a business. So whenever a company issues shares, when you go and buy a share, you have a share in the owner. That's why we call it shares. You have a share in the ownership of the business. So you go for annual general meetings, you have the right to vote. You make decisions for the business. Okay. But when it comes to bonds, bonds is like you have granted, if you buy a bond issued by a firm, it means that you have granted like a loan to the firm. So you are not an owner. You don't make decisions for the firm. All that is due you is that at every point in time, they'll pay you your interest payments. All right. So you are not an owner of you don't have any ownership in the firm. So bonds do not give people ownership in a business, but shares does. All right, shares. And again, for bonds, when it comes to bonds, they have a fixed charge on your assets. So that's why if you look at the preparation of income statement for bonds, they usually pay the interest before they even think about shareholders. All right. Yes. So for bonds, they always have a fixed charge. When I say fixed charge, if you issue a bond at 5%, it means that, let's say, you issue a bond of 50,000 cedis at 5%. So it means that every year the firm will have to pay interest rate of 5% on the 50,000. 5% on the 50,000, all right? Before they even think about shareholders. But when it comes to shares, for shares, you have residual claim. So somebody was asking a question, now so I'm giving the plenty differences, the difference between shares and bonds. Number one, shares grant ownership, bonds do not. Number two, bonds gives a fixed charge on your revenue and on your assets. Fixed charge means that they always, when you buy a bond, they always pay you a fixed payment. So the percentage times the value of the bond, then they'll pay you as interest. Okay. But for shares, it will depend on the profit you make at the end of the day. So for shares, you don't have, for ordinary shares, you don't have a fixed payment. All right. And then when it comes to the payment schedule, okay, when it comes to the payment schedule, usually we pay bonds before we come and pay shareholders. So in a very bad year that after paying all the bonds and then the money gets finished, it simply means that we can't pay shareholders. But then we must also know the difference between ordinary shares and preference shares. So always we call ordinary shares, normally we call it a hybrid security. Preference shares. We normally call preference shares a hybrid security because preference shares we pay them before ordinary shareholders. And why do we call preference shares a hybrid security? We call it a hybrid security because it has both features of bond and it has features of ordinary shares. So for preference shares, we pay them a fixed payment. So you see something like 5% preference shares. It means that we pay 5% on whatever money they contributed. Their payment doesn't depend on our profits. So they are like the bond people. But on the other hand, they are also like equity people because we pay bond people before we pay preference shareholders. All right. Okay. And somebody else is also coming with a question. Somebody said bond rating is like credit bureau report on individual borrower. No. We must know the difference between a credit bureau and then a bond rating agency. They are two different things. Credit bureaus can help bond rating agencies do their work well, but the two of them are different companies altogether. Credit bureaus, they usually have credit history of borrowers. So recently, I think Bank of Ghana issued a statement that like they have credit history of people who have borrowed money through mobile money. And if you don't pay, they will publish your name. So credit bureaus are companies that have records on borrowers' borrowing history. All right. But when it comes to credit rating agencies, they can pick information from credit bureaus to rate you. So credit rating agencies, they are more like they rate you. Credit bureaus just report on your credit history, but credit rating agencies, they'll rate you whether you are risky, less risky, more risky, and stuff like that. It could be that somebody has borrowed a lot in the past, but he's always able to pay. So it doesn't make him very credit. He's not risky. All right. So credit bureaus can provide information that, oh, Mr. A has borrowed every year for the past 20 years, but he always pays. When credit rating agencies get this information, they can rate the person as not credit. I mean, they can rate the person as credit worthy because when he borrows, he always pays. Yeah, so Robert, that is the difference, all right? Okay. Now let's come back to what you're doing. So what is a coupon rate? Coupon rate is interest rate associated with a bond issue. And then we have maturity date, the final date for them to pay you the face value or the par value of the bond. Then the trustee is the official representatives of the bondholders. Then indenture is a legal agreement between the bond issuer and then the bondholder. So always when you buy a bond, there must be an indenture to cover the bond. And the indenture is a legal agreement between the bond issuer and then the bondholders. Okay. Okay. Okay, so if you're a company and then you issue bonds, you just don't sit there one day and say that, okay, you just don't sit down for the bond to mature before you pay. So usually as a company, you have to also set up something we call a sinking fund account. And sinking fund is a fund that we establish so that every year we put some money inside. So in fact, the concept of annuity also applies to sinking fund. For sinking fund, maybe we want to pay back the face value of the bond later. But you just don't sit there one day and then the day of maturity will come for you to pay the bond. No. You as a firm, you also have to set up a fund where you also be contributing money into it periodically. So that at the end of the day, you would be able to pay back the bond that you borrowed. At the end of the day, you'll be able to pay back the bond that you borrowed. Now, when it comes to bonds, we have something we call zero coupon bonds, and then we also have coupon bonds. So when it comes to bonds, we have something we call zero coupon bonds, and we also have coupon bonds. Now, what is zero coupon bonds? Remember, I told you that coupon payment is the interest payment we make on the face value of the bond. All right. So for zero coupon bonds, we do not pay interest until maturity. Only the face value is paid on what? Maturity. Why do you think people buy zero coupon bonds? Why do you think so? Why would people buy zero coupon bonds? The reason why people buy zero coupon bonds is that they will buy it at a lower value. Okay, they will buy it at a lower value. Let me show you something quickly. Let me show you something quickly. Okay. So let's say we are buying 100 bonds at 10 cedis per bond. Or let's say 100 cedis per bond. So the total face value will be equal to 100 times 100 cedis. So that'll be 1,000. That'll be 10,000 cedis. And please let's listen carefully. Let's listen carefully, because we are going to enter into some technicalities soon. Now, this is the total face value. This is the total face value. Now here, it means that at maturity, you will be paid 10,000 cedis. Now, what is the price of the bond? Now listen carefully so that we don't confuse ourselves. The price of a bond is different from the par value of a bond. And there are two different things. The price and then the par value. Par value is how much it will be redeemed at maturity. So as I said, so this can be the total face value or total par value. Total face value or total par value. The money you'll be paid at maturity. So if the bond is for 10 years, in 10 years' time, you should be paid this money back. However, this bond is not paying you interest. It's not paying you interest. Okay? This bond is not paying you interest. So it means that you must buy the bond at a value less than the par value. Otherwise, then there's no need to pay the bond. So a bond that doesn't pay you coupon interest, you must buy it at a price less than the par value. And that will be your gain. That will be your gain. Otherwise, there's no need to buy the bond. The par value of the total par value of a bond is, let's say, 10,000 cedis. So it means that if the bond will mature in 10 years, 10 years time, they will pay you 10,000 cedis. So if you're going to buy the bond today, you must not buy it at 10,000 cedis because of time value of money. If I buy the bond at 10,000 cedis today and 10 years time, they'll pay me 10,000 cedis, then I'm wasting money. So always, for zero coupon bonds, for zero coupon bonds. Always for zero coupon bonds, we buy them at a discount. That is, the price should be less than the par value. For zero coupon bonds, we normally buy them at a discount. Otherwise, you end up not getting anything, all right? So how do we find the price of a zero coupon bond? Remember, they will pay you only one-time payment in future. So how much must I buy the bond now? It is just, if you remember, anytime they are paying you one lump sum in future, you're going to find the present value is what? Future value over 1 plus r raised to the power n, right? Future value over 1 plus r raised to the power n. Okay. So we are going to use the same idea. So the bond price of a zero coupon bond is the face value over 1 plus. Now the interest rate, here we call it yield to maturity raised to the power n. The interest rate is called yield to maturity. In terms of bonds, the interest rate, we refer to it as yield to maturity. Yield to maturity. In terms of bonds, the interest rate is called yield to maturity. Okay. So that is the formula for the bond price of a zero coupon bond. All right. Now, what is yield to maturity? What is the definition? When we say yield to maturity, what is it? Yield to maturity is simply the interest you would have required on similar investment if you went to the market. It is so yield to maturity. The rate of interest. So I'm talking about yield to maturity. Rate of interest or return an investor would have required by undertaking similar investment on the market. There's a simple definition of yield to maturity. The rate of interest or the rate of return an investor would have required by undertaking similar investment on the market. All right. Let's remember something, that when it comes to bond, the coupon interest you are being paid on the bond there, it may not necessarily be the same as the market. Remember that. Like let's say Ghana, if you go to a typical standard bank, like any bank, assuming the interest rate is, let's say 20% or let's say 25%. We all know that is the interest rate, 25%. But when you go and buy a bond from a firm, they may give you 10%. So that 10% will be the interest rate on the bond, and we call it coupon interest rate. We call it coupon interest rate. So coupon interest rate is normally what is agreed between the bond holder and then the bond issuer. Then yield to maturity is the interest rate on similar investment in the market. So usually the coupon interest may be different from the yield to maturity. Yes, they are almost always they are different, because coupon interest is what is agreed between the bond holder and the bond issuer. And it may not be the same as the market. It may never, almost always it's not the same. So let's know the difference between the two. Coupon interest is the interest agreed upon between the bond issuer and then the bond holder. Yield to maturity is the rate of interest of similar investment in the market. They are two different things. So it means that you can go and buy a bond and not get the interest rate that is on the market. And it happens. And you learn all those things that we'll talk about the reasons soon. Okay. So that is the formula for the price of a zero coupon bond. So it says that what is the price of a 10-year zero coupon bond with face value of 10,000 issued 3 years ago if the current yield to maturity on similar bonds is 19.8%. And always for financial management questions, always write down the items. We are looking for price, we don't know. The face value is 10,000. Yield to maturity, 19.8%. Number of years, issued 3 years ago. Oh, no, I made a mistake. So, sorry. So what is the price? So let's read the question carefully. What is the price of a 10-year? So it means that the total maturity from the beginning was 10 years. But the bond is issued 3 years ago. 3 years ago. So it's a 10-year zero coupon bond issued 3 years ago. So the N always in bonds, N, so remember that always in bond, N represents number of years to maturity. Number of years to maturity when it comes to bonds. Number of years to maturity. Number of years to maturity. When it comes to bonds, number of years to maturity. The N. So it simply means that our N is 7. It's not 3. Sorry about that. N is 7. Because it was issued 10 years ago. Sorry, it was issued 3 years ago, and it is a 10-year bond. So the number of years we have till maturity is 7 years. N minus 3. Because it's a 10-year bond issued 3 years ago. All right. All right. So the bond price of a zero coupon bond will be equal to the face value 10,000 over 1 plus the yield to maturity 0.198. That's 19.8%. The number of years to maturity is 7. So when you punch, you get your answer. So there is the answer. Those of you with calculators, can you kindly confirm the answer, whether it's right or wrong? Those of you with calculators. If it's correct, you can just type correct. Okay. Okay, so that's correct. Okay. Now, okay. So we also have a coupon bond. So we've spoken about zero coupon bond. Now we're going to talk about coupon bonds, like the bonds that pay coupon interest payment. Now, always, for every bond there that pays coupon interest payment, so for coupon interest bonds, what happens is that there will be a regular payment of coupon interest. Then they will pay you face value. They will pay you back the face value, the total face value at maturity. They will pay the total face value at maturity. The total face value at maturity. That is how coupon interest works, coupon interest bonds. Now, it means that the receipts on coupon interest bond are in two dimensions. The regular payment of coupon interest and then the payment of face value at maturity. Now, whenever you are receiving a regular payment, it is an annuity. And the face value of at maturity becomes a lump sum. So this simply means that if I want to look at the price, I have to discount the annuity aspect using the formula, the present value of annuity. So 1 minus 1 plus r raised to the power minus n all over r. And I have to also discount the lump sum. So then we will have the face value over 1 plus r raised to the power n. So whenever there are coupon interest payments, that regular payment of coupon interest is an annuity because they pay it every period. So that represents an annuity. And then the final face value will be the lump sum, right? So the bond price here will be the coupon interest payment into bracket 1 minus 1 plus. I told you that when it comes to bond, we don't say interest rate, we call it yield to maturity. Then raised to the power minus n all over yield to maturity plus the face value over 1 plus yield to maturity raised to the power n. So you see that we are employing the concept of time value of money in bond valuation because the regular payment represents annuity. Then the lump sum is the final face value at the end. So this is how we value bonds. And I've told you that, please, when it comes to annuity formula, I keep saying it, the slides use this one. They will do C over the R, or yield to maturity. Then they will do 1 minus 1 over 1 plus yield to maturity raised to the power n, plus FV over 1 plus YTN raised to the power n. I think from the beginning, I told you that for annuity formula, like present value, you can write it as C over R into bracket 1 minus 1 over 1 plus R raised to the power n. Or you can write it as C into bracket 1 over 1 minus 1 over 1 plus R raised to the power n all over R. This R can also come and divide here, either ways. And this thing is also written as C into bracket 1 minus 1 plus R raised to the power minus n all over R. So I normally prefer this formula than this one. The first one, I don't really like it. The second one enables you to read the present value interest factor. So in the slides, when you see the first one, this formula is the same as this. So don't confuse yourself. So you don't come and say that, oh, the slides, the formula is different from what you are giving us. Please, they are the same mathematically. But I prefer this particular one because it can help you read from a table. So I prefer this one. Okay. So this is the formula for finding the bond price of a coupon interest bond. Okay, so let's take a question. The question says that, what is the price of 1,000 cedis par value bond? So it means that the par value or the face value. I mean, the difference between par value and face value is that usually we use face value in the context of total face value, but technically they are the same. Like for instance, if somebody buys 100 shares, 100 bonds, and each of the bonds has a par value of 1,000, it means the total face value will be 100 times 1,000. But if somebody is just buying just one of the bond, the par value is the same as the face value. When a person is buying severally, we multiply the par value by the number of bonds the person is buying. Then we can know the total face value, right? So people normally use par value and face value interchangeably if we are buying only one of them. Okay. So the face value is 1,000. It has 6 years to maturity, so n is equal to 6. And a coupon, so it says a coupon rate. It didn't say yield to maturity. It says coupon rate of 24.5%. And it is semi-annual. And yields on similar bonds on the market are 26. So the yield to maturity is what? 26%. The yield to maturity is 26%. The yield to maturity is 26%. Okay. Now, remember I told you something about compounding periods in our last meeting. If the thing is compounding semi-annually, the number of compounding periods becomes 2, right? If it is compounding semi-annually, the number of compounding periods is 2. If it's compounding monthly, the number of compounding periods will be 12. If it's compounding quarterly, the number of compounding periods will be quarterly will be 4. Semi-annually is 2. All right. So remember, I taught you that anytime we have compounding periods, anywhere you see the interest rate, you divide the interest rate by the number of compounding periods, and you multiply the years by the number of compounding periods. I said this. Whenever we have a number of compounding periods, you divide the interest rate. So if it is 26% per year, it means that every semi-annual will be 13%, half a year. So always we divide the interest rate by the number of compounding periods, and we multiply the time also by the number of compounding periods. And here there are 2 interest rates, the coupon interest rate and then the yield to maturity. So both of them, you divide it by the number of compounding periods. So technically, our yield to maturity becomes 26% divided by 2. 26% divided by 2. And then the coupon interest rate will be 24.5 divided by 2. 24.5 divided by 2. That is 12.25%. Okay. And you see, don't be worried about formulas. Like exams, you'll not be given any formula sheet, but for me, I'm of the firm belief that if you understand what you are doing, you should be able to remember the formula. Because for coupon bonds, the coupon interest payment are annuity. All right, and then the par value is the normal lump sum. So remember that the formula will include present value of annuity and then present value of lump sum. That's all. That's all. That's why I say if you understand what you are doing, you should be able to even quote the formula without chewing it. So we have decoded the question now. Now let's go to the whiteboard. So we said the bond price will be equal to the annuity aspect, the coupon payment, which is the annuity aspect. 1 minus 1 plus R raised to the power minus N. Oh, I'm using R. Sorry about that. I said we use yield to maturity. And all over yield to maturity. And then the power value. One plus yield to maturity raised to the power N. Okay. So remember that now the yield to maturity, we divided it by 2. That's 13% because it's semi-annual. Then the coupon interest rate is 24.5 over 2, that's 12.25. So let's find the coupon payment first. I already told you that coupon payments are usually made on the par value. So the question, the par value was 1,000. So that would be 12.25%. If you send it to decimal, it will be 0.1225. Okay, that's decimal times the par value, which is 1,000. That will be 122.5. That will be the coupon payment. So the coupon interest rate, the only use of the coupon interest rate in the question is to find the coupon payments. That's all, right? So and then now the number of years, we multiply it by the number of compounding periods. So it will be 6 times 12, because we know the number of years is 6. We have semi-annual, so we multiply it by 2, then we have 12. So let's come back to our formula. So it becomes the coupon payment 122.5 into bracket 1 minus 1 plus the yield to maturity is now 13%, so 0.13. Raised to the power, now the number of years becomes 12. It becomes 6 times 2, which is 12, because we have 12 semi-annuals in 6 years. So we have 12 semi-annuals in 6 years. So it becomes minus 12 all over 0.13. Plus par value. The par value is 1,000 all over 1 plus 0.13 raised to the power 12. Those of you who have tables, can you read present value interest factor of annuity 13%, 12 years? So that we get this. If you have a calculator, you can just punch. You can read 13%, 12 years, and get me the answer. Then here too is like saying 1,000 times 1 over 1 plus 0.13 raised to the power 12. So this thing here is present value interest factor of annuity. So you can just read 13%, 12 years. Then this thing here is also present value interest factor, 13%, 12 years. Please, you don't want to read tables, just punch, you get your answer, right? So that you don't confuse yourself. So whatever is in the bracket here is how much? Oh, present value interest factor of annuity table. %, 12 years. It's on your table. Please read it for me. If you don't want to, we just punch everything in the brackets. 1 minus 1 plus this is blah blah blah. Punch and listen. But you can read tables. So 13%, 12 years. So the answer is here, 5.9176. 5.9176, 13%, 12 years. Any different answer? And then the normal discounting, present value interest factor, not of annuity, the normal present value interest factor, 13%, 12 years is 0.2307. 0.2307. So it will be 122.5 into bracket 5.9176 plus 1,000 into bracket 0.2307. So that will be the final answer. So technically, you can even write bond price as coupon payment into bracket present value interest factor of annuity. Then you write the yield to maturity and then the years so that you can just read from the table. Plus par value into bracket present value interest factor, the yield to maturity, and then the years. So this question you could have just said 122.5 into bracket present value interest factor of annuity, 13%, 12 years, plus par value into bracket present value interest factor, 13%, 12 years. Then you can just write 122.5 times 5.9176 plus 1,000 into bracket 0.2307. You write your answer. And this formula is not wrong. You can quote the formula as this. There is nothing wrong. In fact, this formula actually shows that you are reading from a table. But if you want to go the manual approach, you do 1,000 over this. You punch 1,000 over this direct, you get an answer. Rather than multiplying 1,000 by the factor so that it will divide, you can just do 1,000 over the factor straightforward. Like 1,000 over this, you get the answer, then 12 times. So you can do the manual approach. Okay, so what's the final answer? Final answer. What is the final answer? Yeah. So when you punch, this is what you get. So 955.606 is the final answer. So if you are given any bond question at all, it shouldn't be difficult. Okay. If we want to trick you, maybe you change the number of compounding period. We can say quarterly. We can say quarterly you use 4. Yearly we use the yearly there, we don't do anything. Weekly we use 52, 52. Weekly we use 52. All right. Weekly we used 52. Monthly is 12, the compounding period. So no question, and that's the truth. No question will go outside the range of these things I'm talking about. These questions are very easy. As I said, the only trick that will be added is that we may change the number of compounding periods or something. We can say monthly and those things, but technically the idea of these questions, they never change. I mean, in fact, financial management is very, very easy when you understand it. Very, very easy. Okay, so this will bring us to the end of valuation of, this will bring us to the end of introduction to security valuation as well as valuation of bonds. So next, we are going to talk about valuation of shares.